America is pouring somewhere north of $780 billion into AI infrastructure this year alone. Meanwhile, Chinese AI firm DeepSeek knocked $586 billion off Nvidia's market value in a single trading day with roughly 2,000 chips, a $5.6 million training run, and then practically gave the whole thing away for free. Everyone seems to believe that America is winning this AI race. But the strange thing is that Liang Wenfeng, the CEO of DeepSeek, agrees. He just doesn't think that it matters. And in a leaked investor meeting, Wenfeng told us what would have to change for America to lose it. So today we break down why he's so confident, where he might be wrong, and what all of this means for all of the money that's riding on it. My name is Nick, and this is the Finance Bureau. Okay, let's begin with an undeniable fact. In the AI race, America is ahead. According to Stanford's 2026 AI Index, the United States spent 23 times more on private AI investment last year than China did, $285.9 billion against $12.4 billion. And the NIST evaluation from May of this year put DeepSeek's flagship model roughly 8 months behind the global frontier across coding, maths, and reasoning. 8 months behind, but only 4% of the money. And that Stanford index found the capability gap between the best American model and the best Chinese one had narrowed to 2.7 percentage points by March. So if the gap is that thin, what exactly is the $5 trillion valuation on Nvidia actually protecting? Because Nvidia's latest quarter came in at 75% gross margin. For a bit of comparison, guys, TSMC and Broadcom are around 67%, and that difference shows just how far ahead Nvidia actually is. And China's strategy, whether it says so or not, is to close that gap. So let's start with the competitor that apparently isn't trying to make any money. Now, everything I'm about to say comes from a transcript of a DeepSeek investor meeting from May 2026 that leaked into the Chinese media. DeepSeek hasn't confirmed it's genuine, but reports suggest their fundraising plans took a hit around the time it went viral. In it, and consequently across the public interviews going back years, Liang says the same thing. The goal is AGI. Not an IPO and not some grand scheme to capture market share. He reportedly calls the revenue sesame seeds, something you pick up on passing. And his stated pricing philosophy is, quote, neither to sell at a loss nor to seek excessive profits. In practice, that means DeepSeek's cheapest frontier model costs 14 cents per million tokens going in, 28 cents coming out. Analysts put that somewhere between 10 and 50 times cheaper than the Western equivalents, depending on which comparison you use. And the weights are published, so you can download the model and run it yourself. Put simply, you cannot win a price war against someone who is barely charging a price. And what's more, we've seen this film before when it comes to Chinese competitiveness. Solar panels, lithium batteries, electric vehicles. Western manufacturers lost those industries because Chinese competitors turned up and decided that margin was optional. The only difference this time around is that it's happening to software, and software has no shipping costs. Which leads us to the second argument. Liang's claim is that being poor made them better. China can't legally buy the best American chips, so DeepSeek had to squeeze more out of the worse ones. The V3 model's final training run cost about $5.6 million across 2,048 H800s over 55 days. And the reinforcement learning phase behind R1 cost $294,000. And those verified figures come from a peer-reviewed Nature paper he co-authored, so they're about as verified as anything gets in this space. And the argument goes essentially something like this. Give one team an unlimited budget and another team a shoestring, and in 10 years, the second team is the one that actually knows how to build things cheaply at scale. The race was always about who builds an AI model that's good enough and cheap enough. Now, Nvidia's real advantage was never only the silicon. It was CUDA, the software layer the entire world's AI code was written for. Switching to someone else's hardware meant rewriting everything, so nobody switched. And that's the lock-in, and that's what 75% gross margins are actually made of. But Liang's argument is reportedly that this lock-in is dissolving, because AI has now gotten good enough at writing and translating code that the painful part of switching, the part that kept everyone locked in, is becoming a solved problem. Actually, he's alleged to have said that Nvidia is digging its own grave. The logic being that export controls forced Chinese firms off Nvidia hardware, which forced them to build the tools to escape it, which is exactly what Nvidia never wanted anyone to have. To train his next frontier model, Liang reportedly said he'd need about 50,000 Nvidia GB300s, or roughly 200,000 Huawei Ascend 950s. Do the maths and you get a 4-to-1 ratio, 4 Chinese chips to do the work of 1 American one. His forecast is that within about a year, the software problem stops being an issue, and the only thing that decides this is how many chips you can physically manufacture. Because manufacturing is the one contest China has spent 30 years learning how to win. So, a business protected by lock-in effects earns enormous profit margins. A business that just makes things earns thin ones. Same industry, but completely different profit profiles and approaches, and a roughly $5 trillion of market value sitting on which one turns out to be right. Now, keeping track of a convoluted story like this gets tricky, to say the least, and it's pretty much impossible for a single person to stay informed without some help. And that's why you should sign up for the Finance Bureau newsletter. It's completely free, and we break down global markets and macro trends, along with anything else that will move your portfolio, so you never miss the crucial details. Just click the link in the description or scan this QR code on the left of your screen to get started. Right, back to it, because so far I've given you the story as Liang Wenfeng would have me tell it. And that's not to say that there aren't some hard truths there, but Liang Wenfeng is talking his own book. A man who is short of chips has every possible incentive to argue that being short of chips is secretly an advantage. And in part, his own words undercut him. In that leaked transcript, he says the gap between the US and China is, quote, not talent, but purely computing resources. He puts that gap at 12 to 18 months and says with proper chip access, it could shrink to 3. He reportedly said that if he could buy more cards, he'd immediately train something far larger, and that ideally he'd like to spend the money within 6 months. That doesn't sound like somebody talking about a shortage they think is helping them win. Recall that 4-to-1 ratio I just mentioned? 4 times the chips means 4 times the fabs, 4 times the packaging, 4 times the power draw, and 4 times the cooling, which is where the American export controls are designed to bite. And then there's the manufacturing reality in all of this. SMIC or SMIC, China's leading chip maker, is still limited to 7 nanometer class production without the most advanced manufacturing equipment. Analysts estimate that only 5 to 20% of its largest advanced chips are usable. At TSMC, that figure is above 80%. So, even though China produces those wafers more cheaply than TSMC's leading edge, far fewer working chips come from them. And nobody can even agree how many are being made. Estimates for Huawei's 2026 Ascend output range from 600,000 units to 1.6 million. Semi-analysis, doing it on a yield-adjusted basis, reckons Huawei's effective output this year is somewhere between 62,000 and 160,000 top-tier equivalent chips, against nearly 6.9 million from the American supply chain. That's a gap of roughly 170 to 180 times. And the fact that credible analysts disagree by a factor of 10 tells you everything you need to know about how opaque Chinese chip production actually is. And then there's the issue of memory. The industry has shifted from being compute constrained to memory constrained, and China's domestic HBM capacity for AI is running at something like 5,000 wafers a month. Chinese demand this year is estimated at 4.2 million AI chips against a supply of 2.6 million, a shortfall of 1.6 million units blamed mostly on memory. Liang reportedly asked for 200,000 chips for a single training run and was allocated just 16,000. He called the capacity shortfall basically unsolvable for at least 3 years. So the problem goes away in a year is really more of an optimistic prediction than a hard forecast. At the same time, Liang expects the Chinese AI industry to consolidate to roughly 2 large companies and 2 small ones, which means most of the money currently flooding into Chinese AI is going to be incinerated. Oh, and according to Sensor Tower, DeepSeek's consumer app downloads have fallen away sharply this year against its 2025 surge. So for perspective, it's important to remember that it's not like we're looking at an unstoppable machine here. America is ahead today. The argument is more about direction, not the current standings. The AI race will either be won by cleverness or by pure capacity. In this context, cleverness is America's game, and capacity is China's. But there's one other element here that could shake things up. Every model you use today forgets everything the second you close the window. Continual learning and AI that actually learns on the job without wrecking what it already knows is the industry's unsolved problem. And on that, nobody is truly ahead, which means whoever cracks it first jumps the entire queue. So with that in mind, let's run some scenarios. 1. This stays a cleverness race. America holds the lead, the export controls do their job, and today's valuations are roughly fair. 2. It becomes a manufacturing race. The profit drains out of building AI and moves to the physical stuff: power stations, transformers, packaging plants, and raw materials. And that's where things get tricky for the US, because the American grid is already a major bottleneck. Reports this year also suggest local opposition has blocked or delayed a string of data center projects. Meanwhile, Beijing has been shoveling data centers into the western deserts under a state program designed to point cheap subsidied power directly at them. But there's a third scenario. Somebody gives the breakthrough away for free. And then the most valuable software on earth becomes a free download, and every company charging for access to it has a rather serious problem. The situation would look pretty dire if the economics go that direction. Hyperscalers are on track to spend around $760 billion on AI infrastructure this year, while only expensing about $211 billion of it, leaving roughly $549 billion of deferred depreciation waiting to land on income statements from 2027 onwards. The Bank for International Settlements and Moody's have both flagged circular financing as a systemic risk. Hyperscalers funding AI labs, the labs routing that money straight back to buy cloud compute, and everyone booking it as revenue. And the market is already showing signs of nerves. Strip Nvidia out of the Magnificent Seven, and the group's earnings growth this quarter falls from 32% to just under 14%. The whole cohort is up just 2.6% this year, while the S&P 500 has gained about 8% year to date and roughly 16% over the trailing 12 months. You could argue that the rotation has already started. And if the rotation continues, there's likely a scenario where Chinese names win big, having spent 30 years learning to make things at a margin Westerners consider insulting, while the labs themselves never needed the software to be expensive at all. So China doesn't have to win this race, it only needs the prize to stop being worth protecting. And the lab doing the most to make it worthless is doing it deliberately and publishing the results for anyone to check. Well, that's all we have time for today, but what do you think? Is China actually winning the AI race, or is it just winning the cheap end while America keeps the crown? Let me know your thoughts in the comments down below. And if you want to understand just how exposed the whole AI capex boom really is, and what happens when that depreciation wave finally hits the income statements, then you can check out our video on that right over here. As always, thank you very much for watching, and I'll see you in the next one. This is Nick, signing off.